morning, everybody, and welcome to today's session. As you can see, we've finally reached session 5 of 5. So this is audit level 2, where we are discussing how to plan the audit using either our Probe Audit methodology or the Audit International methodology. And today is our last session where we have basically come to the end, where we will have the end result as the audit programs or the work programs, which is, of course, where we picked it up in audit level 1 last year, and where you then took that audit work program and you actually went through and you performed the field work. So today we are going to get to that point, and that is then, of course, the end of our planning, or at least of our training on how to do the planning of the audit. Today we are going to have a look at, again, where are we, what have we done up to now, and what is still left to do in our journey of the audit planning. And then topics that we will discuss today will firstly be material sections with no risks, presumed significant risks, and then also just considering selecting test of controls in the work program or in the work plan. When will we select test of controls? A few other considerations, and then we will go and demonstrate those in the specific software, so either in the Probe Audit or in the Audit International sessions. So let's start then with where are we? So we started the first session of our series by looking at the client acceptance and continuance process, what we had to consider, and we ended with an engagement letter. So that we've done. Obviously, by this time, we've decided to take on the client, and that's all good. Then we started the planning of the audit. And in that case, we started with the understanding of the client. You may remember that we had various documents where we documented specifically the understanding of the client, where we considered the understanding of the client's framework, quite a number of points where we had to consider legal legislation, those kind of things. That's understanding. And then part of that was also then moving towards the risk assessment. For that, we had risk assessment at financial statement level and the risk assessment at assertion level. And that's where we are currently. So we are considering risk assessment at the assertion level, basically your account balance risk assessment. So that's risk assessment. The next step, or part of that step then, is your strategy and planning, so to decide on your audit plan and strategy. But very important, a reminder, you'll see those arrows going all different ways. As soon as we get to a point where we understand a specific risk or identify a risk, we might improve or update or enhance our understanding of the client, understanding of specific account. At the moment that happens, that might actually trigger another part of understanding we need, another risk that we identify, etc. We might change our audit plan and strategy because of that enhanced understanding. So these three parts are always interchanging, always interacting with each other, and that is what the standards mean when they talk about an iterative planning process. You're never really done with your planning. You will often go and continue your work on planning. All right, once we've then decided on the audit plan and strategy, then that would be the point where we will go and move towards the field work or the execution stage. And of course, once you've obtained your further audit procedures or your audit evidence from the further audit procedures, that's when you then move towards the finalization stage. Right, so that's where we are today, in the green, in the planning, mostly then in the risk assessment stage. But as you will see, we often still get and obtain a further understanding of the client, and then also amend our audit plan and strategy. Good. Considering then, when we have material sections with no risk, how do we deal with that? So this really is just a very simplified flow in terms of the planning process, and we'll look at it from a different perspective as well. But perhaps this might also be helpful for you to see. So we started off understanding the client, and we've mentioned that also in the previous slide. And from there, we gather evidence. We start with risk assessment procedures including analytical review, inspection, observation, and we gather evidence about our understanding of the client. From there, we raise risks for either sections or assertions. We might even raise overall risks. And we then plan procedures and responses to address the risks that we've identified. Then, for material sections with no risk, the standard requires us to perform a so-called standback. The standback says you have to then consider, you have to consider whether you have actually performed all the risk assessment procedures necessary, in the sense that have you done sufficient risk assessment procedures to have identified a risk of material misstatement if or when those would have appeared? Right. Then also maybe just another thought, how do I identify material items? That will be items that are either from a quantity, so numbers perspective, equal to or above performance materiality. And you will also consider qualitative considerations in the sense that if a matter, even if the point is not necessarily a number, so in other words, therefore cannot be more than the number, but if it is qualitatively material from a quality perspective for the users to want to need to see that information being focused on it, then that will also be a material item, and again, we'll need to perform a stand back. In terms of the materiality, I mentioned now that the balance would be equal to or more than performance materiality or specific materiality. If I have identified a very specific materiality, then that will, of course, be a value that is more than specific materiality. All right. Now, even though we've got a beautiful circle, at that point in time, when we do identify the material items and we perform a stand back, it's quite possible, of course, to say, hang on. I actually did now identify a risk, and then go basically right across the circle, go back to risk assessment, document those, then raise the risk, and so forth. So it's a bit messier than just a plain simple circle. All right. So that's first of all. Then for material sections with no risk, we'll perform a stand back, and then even if we then conclude that having performed the stand back, having concluded that yes, we agree there is no risk of material misstatement to identify for this account or this section, the standard then says, right, if you have performed your stand back, we're sure you didn't identify the risk that may be there, but you still need to perform some substantive work on that material balance. So the standards say all material balances must have some substantive work to be performed. So we'll go and select the most likely assertion that is most likely to have a material misstatement. We have said there's no risk of material misstatement, but which one is then the most likely one? And that will then be the assertion for which we will go and plan responses, go and do work. All right, so it looks like a beautiful circle, but of course it can be a bit more messy, a bit different than just simply going right around the circle. Now, a reminder again, we don't just stop when we finish. Even as we are performing our field work, we will also improve our understanding of the client's business, and possibly, again, even in a work program, you might actually identify another risk of material misstatement, and you'll have to record that. At that point, you won't go back to the section 11 and necessarily go and record the risks there. In some cases, you can actually just switch on the procedures in the work program for those, but at least you will have identified the risk and make sure that your work program does have the necessary responses. So when are we doing specific or what work? So when we have these material sections, we know risks has been identified. We've said now before, we'll do the stand back procedure, and we'll ask ourselves, have we done everything? Are we sure we didn't miss any risks of material mistake? And then, as we've mentioned, I then need to select an assertion for testing. So that would basically be your most likely assertion that could go wrong. And just the fact that you're identifying that, of course, does not say that there's a risk. We do treat those differently. So once I've then got a so-called selected assertion, that is where we are going to do field work. And so to test the selected assertion will just basically require work procedures to go and respond to that assertion. These will be substantive procedures, right? The standard says you need to do some substantive procedure for every material balance, so we will need to include some substantive procedures. This is similar-ish, but not quite the same to when we have a risk that we've identified for an account balance for an assertion. So when we have erased or identified a risk and we raised that risk, we recorded that risk, we would have identified a relevant assertion. All right, so that relevant assertion then is, of course, the assertion or assertions where we believe there is an inherent risk of material mistake. Now, the standard things say you have to obtain for those, well, let me just, before we get to that, remind you of the definitions. So a relevant assertion is an assertion for which we have a risk recorded. And the class of transactions or the account balance or the disclosure that has a relevant assertion is then identified or referred to as a significant class of transaction account balance disclosure. Significant because there is a risk, okay? Not a significant risk, but just that got to be is now as got to be. So as the moment you have a class of transaction, account balance, or disclosure with a risk for a relevant assertion identified or recorded, then the standards say we must obtain a description of the information system. So we don't have to necessarily go and test controls or identify controls, but we need to at least get a system description. That's your design and implementation. Sorry, not design and implementation. That is your document, your understanding of the flow of the information. And having then obtained your system description, then you will go and design procedures to test the risk of material misstatement. Good. So either way, we're going to end up with some field work, but there is that slight difference. All right. So let's then start with a quick poll. I want to know, in a scenario where there's a material balance with no risks raised, when we selected an assertion for testing, is a system description, a description of the flow of information required in our audit file? So this is a very interesting result. So we have 62% of delegates saying, yes, I need a system description when I have a material balance with no risk raised and just a selected assertion. And 38% of you said, no, I don't need a system description. Now, very important, the standard does not require a material balance with no risk to have a system description. Let's go back to that slide so we can see it. All right, so the question that I asked you was related to the right-hand side. Oh, I see I haven't hidden the poll yet. Let's hide the poll so you can actually see my slide. So the question that I asked related to the right-hand side of this slide. So let me get my laser pointer. So I said we've got a material balance, material section, with no risk identified. We performed our stand back. We said, are we sure there really is no risk of material misstatement for this account or this section? And we said, yes, we are sure. There really is nothing. The standard then says we must select an assertion to test, to say what is the possibility, or even if there's no risk, if something had to go wrong, where would it possibly go wrong? And we pick that assertion, we select that assertion. And we refer to that as a selected assertion in the probe methodology. Even in AI, you'll also select an assertion to say this is the assertion we're going to test, even though there's no risk. And then you see the difference here between the coral one on the right-hand side and the coral on the left-hand side. The left-hand side one says where you have recorded a risk, you have that relevant select assertion, you've got the significant class of transaction, then you must do a system description. For the material balance, no risk identified, there is no requirement to do a system description. Yes, we're going to have to do substantive field work. We're going to probably do an, what is the word now? Substantive analytical review, create expectations, or we're going to go and select material invoices. We're going to do a sample, something like that to get to the point of saying, I have tested the items in detail and I'm comfortable that there's no material misstatement. But I do not have to perform or identify or document a system description. By all means, if you want to, you're welcome to do that. All right. But the standard does not require that. And that's also why the software does not prompt you or require you to do that at all. All right. I don't see any questions coming in about that. So hopefully that was rather just a wake-up call, just the coffee hasn't kicked in moment. But it is also important to stress that, because I know we can get, I just want to say, just confused a little bit when we get to the software and get to that point. Right, so let's have a look then at the next topic. So first of all then is our presumed significant risks. Oh, I see I'm missing some standard references and a bracket. Apologize, I'll fix that before I share the slides with you. But this presumed significant risks are included in ISO 240, which is the fraud standard, as well as the related party standard. So you might think, but what about the revenue one? We're going to see the revenue one, but that's also part of the fraud standard. All right, so those are the two standards that prescribe the significant risks, the presumed fraud risks. All right, presume basically says it is assumed that these are always risks. All right, so in the majority of engagement files, we will see these risks, and we will see these risks recorded. Having said that, now, of course, there are some hurdles sometimes that you have to get over, but we'll talk about those just now. So in last week's session, session 4, we discussed the fraud risk at financial statement level. Sorry, not last week. It must have been the previous session, session 3 already, where we discussed the management override of controls, which was a fraud risk at financial statement level, where we then discussed the fact that there is always this fraud risk that management might override the controls in the business and therefore, through that manner, commit fraud. And our standard responses in the methodologies, again, prescribed by the standard, then asked of us to perform certain procedures in testing estimates. It asked us to perform specific procedures on journal entry testing and also to identify and then go and test the appropriateness of transactions outside the normal course of business. So the transactions outside the normal course of business, those would be with anyone. We will also just go and see the ones about the related party transactions just now. All right. So the first one was the financial statement level risk of material misstatement that we dealt with, the management override of controls. The second one then we mentioned was the related party transactions outside the normal course of business. Right. So what's the first question? The first question or the first hurdle is, does the client have any transactions with related parties? Now, that's not necessarily dodgy or risky or strange even. I'm sure you can immediately think of a number of your clients where there are related parties, first of all, and where they actually engage in transactions with those related parties. That is quite normal. So that's not necessarily already a red flag for us, but it's the start of us considering, is there a presumed fraud risk in this case? So that's the first point. Are there transactions with related parties? The second question is, are these transactions with related parties, and again, there we have that question, the word significant, not material, significant. Significant to a large degree, and I'm very loosely now making that connection, but to a large degree, the word or the term significant means needing special attention, extra important, big, things like that. Why am I saying that? Well, with significant, we said that a significant risk is a risk requiring special order consideration. With a significant class of transaction account balance disclosure, we said, hang on, these classes of transactions account balances disclosure are important for us in the audit because they need an audit response. They need a certain description. There is a risk recorded for them. So related party transactions, not the end of the world. Are they material? That's also okay. Sometimes a lot of businesses actually have the related party as the sole or primary supplier of material. That's also fine. The question is it significant? Is it different in the business? Is it big enough amount that it is actually going to warrant extra attention and that it actually will make up a big part of the financial statement information? So it could be material and significant, but it could also be material and not significant, or it could not be material, qualitatively at least, and still be significant. So is this important? So we've got transactions with related parties. The transaction is significant. Now the last hurdle then. Is this transaction, or are these transactions that we have with related parties that we've determined are significant, are they outside the normal course of business for our auditee, for the client that we are auditing? Because the moment we have transactions with related parties that are significant, and all three parts must be there, and these transactions are outside the normal course of business, then the standard for related parties says then this is always a fraud risk or a significant risk, because then there may be fraud taking place here. Apologies. And therefore, you must then record this as a significant risk. And of course, the moment it's a significant risk, you need special responses to this. All right. So those are the three parts: transactions with related parties that are significant and that are outside the normal course of business. Now, let's go and do some. Apologize. It seems like it's a bit early for my throat, for my voice. Let's go and do some polls and see the application of this theory. Good. So first point, we are auditing company A. And in all of these scenarios, we are going to be auditing company A. Company's A business is to sell cutlery. Company A has a related party, which is called Company B. Company B buys all of Company A's furniture and fittings because A is moving to new premises, and that premises is already fully furnished. So all the tables, all the chairs, all the furniture and fittings. Okay, they are taking their manufacturing equipment with them, things like that, but the furniture and fittings is being bought by Company B. Now, in the books of Company A, furniture and fittings was a significant or material balance. The question is, have all three parts of the risk criteria been met? Yes or no? All right, so what we see here is that 63% of you say yes, this meets the requirement or the criteria for recording the significant risk. 37% of you say no. So it looks like the majority of you are saying yes, it is. Let's go and have a look also just at the standard and remind ourselves again. So I'm just going to go back to that slide and say, so Company A has a transaction with the related parties. Yes, that's Company B is the related party. Is the transaction significant? Well, all of the furniture and fittings, which was a significant balance, but even just the fact that all of the furniture and fittings, and it's not just the teeny tiny balance, is sold to Company B. Now the third parties, is selling your furniture and fitting outside the normal course of business? Yes, it is outside the normal course of business. So I agree with 63% of you that said, yes, all three parts of the criteria are met, and therefore we will need to record a significant risk for related party transactions outside the normal course of business. Right, thank you for your participation on that one. Now let's go and see what happens with the next one. So would your answer change if only a boardroom table was purchased by B? So we still have Company A that sells cutlery. Company B is a related party and buys not all the furniture and fittings, but the boardroom table. Is it now meeting the criteria or not for a presumed fraud risk? So let's see what you say in this poll. This one, of course, had another response. The option was it depends on the significance. That's kind of giving it away. Hey? So 61% of you were indeed correct to say it depends on the significance of the boardroom table. So again, we've got a significant a related party transaction. A is selling to B. We've got a possibly a significance. We'll have to look at that. But the outside the normal course of business, yes, it is not normal for A to sell furniture and fittings because they normally sell cutlery. So what about the significance thing for those of you that weren't sure? So the significance is whether the boardroom table that's being sold, that transaction of selling that boardroom, is it a significant transaction with A? So the question is whether the boardroom table was perhaps the biggest and almost only furniture and fitting item, because if there were only, I don't know, let's say 4 chairs around the table, but this table was a very fancy, very big, very expensive boardroom table, then maybe yes, then maybe that is a significant transaction with related parties outside the normal course of business. But if the boardroom table was actually just one of many things, small, big, doesn't matter, not very expensive, not very durable, then it might not have been significant and therefore then would not have been a presumed fraud risk because the transaction would have been with related parties, not significant, and therefore we almost don't even worry if it's outside the normal course of business. All right, good. Let's look at the next one. Is the significance a significant risk applicable if all that B purchases from A was the cutlery? So B purchased all of A's cutlery, not all of A's furniture and fittings. 63% of you said no. When B is purchasing cutlery from A, that is not a significant risk. And I'm sure if I asked you why, you would have said to me, but it is A's business to sell cutlery. So yes, it is a transaction. Yes, it may be a significant transaction, especially if they're buying all of the cutlery from A. But is it outside the normal course of business for A to sell cutlery? No, absolutely not. It's entirely possible. So in that case, it would not be a significant risk and therefore perfectly fine. All right, so we've considered now what is the requirement to raise or recognize the significant risk for related party transactions. But what do we need to do when we do record those significant risks. So the standard then says that when you have identified significant related party transactions outside the normal course of business, you have to respond in the following manner. Firstly, inspect the underlying contracts or agreements that supports this transaction or transactions, and then evaluate the business rationale. So does it make sense for B to buy the furniture and fittings? Well, maybe B is a second-hand furniture store and it makes complete sense. So, well, if A doesn't need it anymore, then of course they're going to need it. Or maybe there is some other dodgy reason that could be indicating possible fraud. Look at the terms, look at the explanations for those terms. Why are these terms so much more beneficial? Things like that. Just make sure that it is not indicating that fraud is being committed, that the transaction is recorded in a manner or displayed in the financial statements, disclosed in the financial statements in a manner that is not true to the way that it was done. Is the accounting and the disclosure done appropriately? And then also, don't forget about this part also, is the transaction or transactions appropriately authorized and approved within A? In other words, did someone just decide they're going to sell it all and that's how it was done? Or was there a process maybe by the directors or management or whatever the transaction was would obviously determine what type of authorization and approval is required. But did they get the necessary transaction and approval that they needed? Right. The next part then also is to say that for all transaction, all, whether it is a significant risk or not, so any transactions with related parties, if management discloses in the financial statements that transactions are at arm's length, then that is I was going to say like a qualitatively material disclosure made in the financials, and then we have to go and get evidence that that is in fact the case. So important thing is that this, I want to call it light blue block on the right hand side, that one is for all related party transactions. So I almost want to flip the coin and say we only have to test if transactions with related parties are at arm's length if management discloses that those transactions are at arm's length in the financial statements. Otherwise, we don't have to test whether a transaction is at arm's length. And to reiterate it, it is not driven by the fact that there's a significant risk, or there's a fraud risk, anything like that. All right, let me say that again. When we have a significant risk for related party transactions outside the normal course of business, we have to do the items on the left in the dark blue. We've got to evaluate the business rationale, inspect and evaluate the terms and the explanation for those terms, consider whether the accounting and disclosure is done appropriately, and get evidence that it was appropriately authorized and approved. We do not, for those transactions, just by the fact that there are significant risks, have to test whether they are in fact at arm's length. We only have to obtain audit evidence that transactions are at arm's length if management disclosed in the financial statements that the transactions are at arm's length. And that's quite a lot of work to go and test, because now you've got to go and actually test and check what are the other transactions. In other words, get evidence of what is transactions at arm's length, and then go and check what was on this case and see that they are quite drastically different, etc. Moving on, just another point that is quite important to note in terms of related party transactions is that whenever we have previously unidentified related parties or undisclosed related parties, or unidentified undisclosed significant transactions with related parties, then the standard says now there's a big red flag. So of course, initially we'll ask the client, who are your related parties? What transactions do you have with related parties? And they'll give us a list, or they'll say how we can determine them, etc. But if during our audit work we come across any specific or new related parties or specific transactions with them that were not previously disclosed, then there's a red flag that goes up and says, oh, hang on, check this, check this. Why did they not tell us this? Okay, so first of all, first step is we will have to go and either confirm that there are in fact related parties, or get evidence that they actually do not exist, but that they aren't related parties of ours. So that's the first part, is to go and check and say, are these really related parties or not? The second thing then is, if they are related parties and these are transactions with related parties, then the standard is, step one, confirm these related parties, not confirm, communicate these related parties to the engagement team so that everybody is aware that we have just identified company C as a related party, or we've just identified that the transactions with company C are actually also significant transactions with related parties. We didn't know that C is a related party, but we've now identified and confirmed that. All right, so we communicate to the team so that everybody can be alert to significant parties, transactions with significant parties, and outstanding balances from transactions with significant parties. Oh, sorry, not significant parties, related parties. My words are getting mushed up today. Then, second step, ask management to identify further transactions. And I want to go further, is to say also further related parties. To say, guys, we got the list from you. You gave it to us, but there were some items missing here. So please will you have a look at it again, re-look at it and see whether there are any related parties outstanding from this list and any transactions outstanding from this list of transactions with related parties. Please have a second look. Hopefully they'll look at it and let's hope they'll say they are all on there, and in fact they are all on there. Hopefully they won't hide any from us again or forget to tell us about it. It's not that the intention is by default to hide stuff and to be dodgy or anything like that, but one does start to wonder and say, why did they not tell me about this one? And to maybe look at it. Okay, so that's the point there. Communicate with your team, request for management to go and see if there are any others that should also be on the list. Then the standard says you have to go and investigate what control the client had that failed and why it failed. Investigate the reason for the failure to ensure that all related party transactions and all related parties and outstanding balances were actually included on that list. So why was this item not on the list? Then you'll go and do your normal testing like you would for any other related parties to confirm the business rationale, etc., test all of that normally, make sure that it is legitimate transactions appropriately disclosed, etc. Then the standard says reconsider your risk. I was going to say the risks recorded for related party transactions, but possibly, depending on how far and wide this stretches, even just the risk across the financial statement levels, to say inherently fraud control risk at financial statement level, are they still appropriate? And then to hopefully, this is never intentionally left out, but if we do identify that this undisclosed, unidentified related parties or transactions were intentionally not communicated to us, the standard says you have to treat this as fraud. You have to evaluate or re-evaluate whether you want to be involved in this audit or whether you want to withdraw from the audit. All right, so that gets serious, because now you actually can't trust management anymore when they tell you something, because they have tried to hide related parties. That, of course, should be the exception to the rule. This should not be something that happens on every single audit. Right. Good. Moving on to our third risk. So the first one we had was management override of controls. The second one was related party, significant risk, when we've got related party transactions, significant related party transactions outside the normal course of business. The third last presumed risk is then the fraud in revenue recognition. Now, the other two that we've dealt with up to this point, very important. There is no choice to rebut those two risks. Okay. In fraud, you have the option, in revenue recognition, you have the option to rebut the fraud risk, but not in the fraud risk for management override of controls and not in the significant related party transactions outside the normal course of business. Good. So for fraud in revenue recognition, the standard says you need to go and identify the type of revenue where the fraud could possibly take place. So there could be a specific type, a revenue stream where there could be fraud. That's more likely than others. You can go and identify the transactions, the type of transactions that could have fraud in the revenue recognition thereof. And there are also specific assertions that you can identify for them. So it doesn't mean all of revenue, the whole balance, all assertions, all revenue types, etc., will always have fraud risk. Standard says you could go and identify it for a specific type of revenue stream, transaction, type of transaction, or specific assertion or assertions. All right. The good news is that this risk is rebuttable. How do I rebut this? Well, basically the standard says, the interpretation of the standard in the cycle of frequently asked questions says that once you have done the risk assessment for each of the assertions, by default then, if you did not identify an inherently fraud risk for any of those, you can then, let's say, assume I intentionally don't use the word presume. You can then assume that there is no fraud risk. However, you need to document this in a very careful manner. The scenarios also where you can actually say that there really is no fraud risk inherent in any type of revenue, any transactions, any assertions are really limited. I mean, it's even on the slide there to say really limited scenarios, limited instances, and very important that we need to document that and how we have rebutted that. All right, so again, just to reiterate, it can be in a specific type of revenue, specific types of transactions, specific assertions, does not have to be all of them. Right. I just want to see, it looked like someone raised their hands for a second. Just remember that if you are raising your hands, I cannot necessarily see what that would mean. So it's best to rather just submit a question if you have any concerns. Right, so the example that that the standard provides of when you can rebut this risk, when you can say that there really is no possibility of material misstatement from fraud for the revenue recognition, is an example is where you have a single property that you are renting out. So there's only one property, you know there's only one property, you know that it was rented out, and you can basically go and just confirm that by saying, here's the lease agreement. We can clearly see there was no scope for manipulation. But now already I'm thinking that when the standard was written, and that was given as an example, I don't think we had something like Airbnb. So, you know, if I'm renting out my factory to one other business and I'm renting it out for the full year, there's no scope for manipulating it. I can show the contract that ran from maybe even before the financial period started until at or after the financial period. I can show there was only one contract because it was already fully let out for the period. Apologies. So from having one property, one contract for rental, rented out for the full period, there's no scope for fraud. But I've referred now to the property possibly rented out as Airbnb. There it might be a bit more difficult to say there's really no manipulation, no possibility of manipulation, because I doubt it you're going to have a property rented out to one individual for the full duration of the financial year. Even if you have it rented out lots of times, it's possible that not all days would have been rented out. It's possible that some days may have been rented out at a higher price than the others. So there is a lot of scope of manipulating the revenue recognized for that property that is being rented out on Airbnb. Okay, standard doesn't talk about Airbnb. I'm just taking it a bit further to say, don't just get stuck on what the standard has said when it was written. We've got a question here. Thank you for that one. Can we say the investment income or interest income from the bank is also rebuttable because we can identify it as revenue and therefore recognize fraud in revenue? Can we say the investment income or interest income from the bank? I'm not sure what you want to say about that. Let me just see if I'm seeing the whole question. I'm not sure what the question is exactly. Maybe just clarify that for me. But while you are clarifying that, I'm also going to quickly discuss investment income or interest income from the bank. So remember now that if I have wrap-up manufacturing that we have today, wrap-up manufacturing is, well, it's manufacturing and then selling wholesale. So the revenue line item for wrap-up manufacturing is going to be sale of goods. But if I have an investment company, so I think that is possibly also what the question is referring to. If I have an investment company and the revenue is not sale of goods, the revenue line item is actually investment income or interest income, then I need to know that the revenue, being the interest income or the investment income, that is then possibly susceptible to fraud in revenue recognition. So just because I'm not selling items doesn't mean that there's no fraud risk for revenue recognition. So I need to then also go and consider for my, let's call it for now, different type of revenue, the interest income, the dividend income, the investment income, that type of different type of revenue income. I still need to go and consider and say, what is the possibility that this item may be materially misstated and specifically material misstated as part of the revenue recognition from a fraudulent perspective. Right, so that still needs to be considered, even if I'm not selling normal goods or let's say having I almost want to say the type of revenue that you would expect. All right, it looks like I've answered that question, so that's also good. That is also just in the next step. Good. Let's do another poll. You must be tired of polls already, but this is my last one. Let's go and have a look at this poll. So my question to you is, fraud in revenue recognition is only applicable, possible, relevant to occurrence and or completeness. Would you say that I would only record fraud for occurrence as an assertion and or for completeness as an assertion? What do you think? So the audience has voted and said only 33% of you said yes, fraud in revenue recognition as a risk of material misstatement can only be recognized for occurrence and completeness. 67% of you, 2/3 of you said no, this is not true. There are other assertions that are also possible. That is 100% correct. 2/3 of you are correct. So the standard uses two examples when it talks about fraud in revenue recognition, and it talks about possible overstatement and then refers to occurrence assertion, and possible understatement and refers to completeness as a risk. But there are also other assertions, and for any of those other assertions, there can also be fraud in revenue recognition. Let's think, for example, about cutoff. If a client really wants to manipulate the revenue, probably one of the easy ways is to actually just continue recording more revenue at the end of the year. Just make a cutoff error. Just add extra sales in so that you can automatically show a bit bigger revenue. That's a cutoff issue. That's not a completeness issue or an occurrence issue because the transactions did occur. It is a cutoff issue. It can be accuracy, where perhaps, I don't know, let's say we are using exchange differences or rather exchange rates to record the transactions at the correct date, and oopsie, I used the wrong exchange rate. So it can be any assertion related to the class of transaction of revenue recognition where the fraud risk could occur. Right, so very important. And even more so, I've seen a lot of instances where delegates or files only refer to completeness and then says, but that's the risk for revenue. There's no other risk. There is also the possibility of occurrence. And interestingly enough, the standard refers to occurrence first. It first talks about overstatement and then about understatement. And but still, any of the assertions that you can pick as a risk of material misstatement for revenue can then also be the fraud risk for revenue recognition. All right. Okay, we're going to now take a comfort break, and then after that we will continue with the next section. Let me just quickly go back to that section. So then we will discuss the selecting items to perform test of, sorry, not selecting items, but selecting in our audit plan and strategy to perform test of controls. But I see that it's already gone 10 o'clock, so let's take a comfort break. There's not a lot of theory left for us, and then we're going to actually break out into our different sections a little bit earlier to really work through all of the theory that we're discussing, but in our separate methodologies. So I know it's a bit of theory now to just get started, but once we're done through the theory, we're going to go and look at the documentation. So again, in this tea break then, while we have a comfort break, if you have not downloaded the caseware file before, I would recommend that you do so. We're really going to be documenting a lot today. Of course, you can always follow along in the engagement or in the view that I'm going to show you on the screen, and then maybe do it later on or so. But I also find that if I'm in a webinar, it's best to do what I need to in that webinar, because it's always difficult to come back and say, right, let's get this done now. So if you want to download that caseware file, still do that now is my recommendation. At the same time, if you had already downloaded it before, it is the level 2 engagement file. It's the same file that I worked in last week and the week before and all the other sessions. So if you've got a level 2 file, that's the one. You can just open that up and we are going to start working in that one then soonish. But if you've got that downloaded already, you know you're ready, either the Probe or the Audit International one. And then after the tea break, we will just finish off the theory before we then do the breakout. And as mentioned, we are now going to start with the selecting to perform test of controls, or TOCs, in case you were wondering what that stands for. Right, so what does the standard say? When do we have to test controls? In other words, selecting the, I want to say, like normally maybe your firm methodology says 22 or 30 or so items to go and test controls. When must you go and select those 22 or 30 items to test controls? It's not always the case. So there are really only, let's say, two cases. Okay? Firstly, when substantive procedures alone do not provide sufficient appropriate audit evidence. And that, from the standards perspective, they give an example, and I know this is very boring. The example is in a retailer's case. So if you go to wherever you buy your bread and your groceries and your whatnots, if you had to go and audit that grocer, how would you ensure that all the revenue, all the inventory that left that store was actually invoiced or recorded on the cash registers? Well, you cannot test that through substantive procedures alone. You will sit there for 100 years and still not have audited 1 year. It's just not possible to do it through substantive procedures alone. To prove it through that manner, we have to rely on controls to be operating effectively. And so because we have to rely on controls to be operating effectively, we have to test the operating effectiveness of those controls. So that's the one example. Another example that, many of you can say to me, yes, but where am I now ever going to audit a big retailer? That's not part of our firm's engagements. Some other examples, telecommunications, where the client generates or earns revenue through selling calls, data activity, things like that. If you think your cell phone provider, how would you confirm the accuracy, the completeness, the occurrence of those revenue transactions? Well, yes, you actually, accuracy you can probably to some degree check, but also how long was those calls, those kind of things. You will actually need to identify the client's controls that they have in place to ensure that those are recorded correctly, accurately, validly, and go and test those controls in order to get anywhere near sufficient appropriate audit evidence for the revenue line item. Okay, so that's a revenue line item example. Another one that also links revenue, but that could maybe even link inventory, is something similar. But yeah, we're not selling data activities or calls. We're actually selling, I want to use the word vouchers, but listen carefully, codes that get sold, and that code represents a voucher for prepaid airtime or something like that. So in that case, I will need to test the controls both for the revenue that was generated or recorded through selling of those vouchers, but also the codes themselves are not physical codes. So I cannot physically go and select them, pick them up, touch them, see them, anything like that to test them, to go and see that they are there, that they exist, to go and count them, think an inventory count, right? So how will I test the existence and the completeness of inventory? I will have to go and test the controls around those codes, okay? I just want to check, I think I had another example. Now, those were the examples for now. So the retailer, and then, of course, in telecommunications. Now, something like the codes for vouchers, that is something that you might come across. And I mean, as we have technology changing and improving, feels like every hour. So you might actually come across those kind of things, even if you are in a smaller or a medium-sized business, where you may not necessarily have done that for a big retailer. All right, so that's the first instance when you have to test controls because you said you cannot get sufficient appropriate audit evidence through testing substantively alone. The second one is when your assessment of risk of material misstatement includes or reflects an expectation that controls are working. Or basically, if you want to rely on controls working effectively and getting sufficient appropriate audit evidence, then guess what? Then you have to test controls. So you will use your knowledge of and reference of your firm's methodology and consider the most efficient way to determine the audit plan and strategy to determine whether you have to test controls, the details of controls, right? All right, so you may decrease substantive testing by testing controls, but you cannot eliminate substantive testing for those instances where we have to test material items through substantive procedures. So yes, if you're, let's say you have to select all the material transactions and they are maybe, I don't know, let's say 27 items, but that doesn't give you sufficient appropriate audit evidence for substantive work. So you've got to also go and select a sample to test detail. And that sample is maybe going to be 500 items. And you're saying, oh my word, that's going to take me forever. let's rather go and test the controls. If I can identify controls that will appropriately address that risk, and therefore I can rely on those controls operating effectively and effectively preventing and detecting or correcting material misstatements, then I can actually say that my risk of material misstatement overall, for that assertion, the risk of material misstatement includes both the inherent risk assessment and the reliance on the controls. And then I can actually test less substantively. My sample size may be reduced, and I'm just picking numbers here from my brain, maybe from 500 to maybe 150, something like that. I see a question coming in. Okay, so the selection of tests of control depends on the firm methodology or the standard. So the standard, as in the auditing standards, only require you to test the operating effectiveness of controls if, and these are the 2 points on the standard, when the substantive procedures alone do not provide sufficient appropriate audit evidence, and when your risk of material misstatement, your assessed risk of material misstatement, reflects an expectation that controls are going to be working or operating effectively and therefore give you some form of audit evidence. The standard does not require any other instances where you have to, must, prescribe, auditor shall, any of those where you must go and test the operating effectiveness of controls. So if those 2 points are not relevant, you will then refer to whether your firm has specific scenarios in the methodology where you need to test controls, or if there aren't any requirements in your firm's methodology to require specific scenarios where controls are tested, then you consider efficiency. What is the best, most cost-effective way to get the sufficient appropriate audit evidence for this risk that you need to address? Good, so having considered controls, then let's just think about some other considerations. So in this series, we are addressing planning and audit, but there are so many other things to consider, even just in terms of generally responding to the controls, responding to risks that we've recorded, or responding to matters that we've identified, or when we have to rely on the client's management expert, things like that, that we haven't even dealt with. But there is something else that I want us to consider in today's session, and that is specifically when there are disclosure items in the financial statements, and we are auditing the financial statements. So we've considered balances in the client's financial statements, but I also want us to consider disclosure items. So what are disclosure items? Disclosure items could be something like the statement of cash flows, or the cash flow statement, if you refer to it like that. It could be the risk management note, and specifically the wording and other information in the risk management note. So those things are not directly linked to a specific balance or line item in the financial statements, the balance sheet, the income statement, the statement of changes in equity, etc. But the materiality consideration is still applicable, even though there's no number driven. It could still be qualitatively material. Of course, it could be quantitatively material as well. So we still need to assess the risk. We need to consider the flow of the information, the system description, and as is necessary. Again, I'm not sure what this question is. Related party is not a disclosure item, question mark. Are you asking if related party is a disclosure item? I'm not sure what the question is there. But disclosure items, statements of cash flow, risk management note disclosures, things like that, any and all other items, that's not part of the balance sheet, not part of the notes directly linked to those balances, those kind of things, it also need to be considered. And so what you will see is that we have then separate sections to consider the risk for those items, and of course then work programs as well. Right, that brings us to the breakout time.